On Small Cap Power, we welcome Robin Speziale, the author of Market Masters and Lessons from the Successful Investor. Robin, thank you for being here.
Thanks for having me, Rachel.
So share with us what the inspiration behind Market Masters is and what the book is about.
Yeah, sure. So I wrote Market Masters at the beginning of 2015. And my inspiration was really the fact that there's no good investment book out there in Canada written by a Canadian. As well, one of my inspirations growing up was the series by Jack Schwager, Market Wizards. And so I wanted to create a book of our very own here in Canada, Market Masters, and it released in February 2016.
Okay, so who do you interview and talk to for the book?
Sure, so there's about 20 investors in total in Market Masters. I interview people like, for example, Bill Ackman, who's not a Canadian, but invests in some pretty large Canadian companies over his time. I talked to Francis Chu, who was the famous value investor here in Canada. Jason Donville, who's the famous growth investor. And those are just 3 of the 20 investors who I interviewed.
So among those investors, what was the greatest takeaway? What would you say was common among these people?
Okay, so the 3 common things among these investors is, number 1, obviously a superior intellect, above average IQ, obviously. Number 2 is a drive, though. It's a drive to beat the market. Otherwise, these investors would have their own money and their clients' money in index funds. So beating the market. The number 3, it's their humbleness in the market. Because of the volatility of the markets going through different market cycles and recessions, they've been able to correct their mistakes and come out ahead as well. You
started to invest when you were 12. Or
exactly.
Knew you wanted to be rich when you were 12.
Yeah.
Who introduced you to stock investing?
So it was actually, I started to buy bonds when I was 12 years old. Of course, like many of the people that we hear about, Warren Buffett, whatnot, one of the easiest jobs to get then was a paper route. Started on the paper route. It was my mom who suggested, you know what, Robin, start buying some bonds. I bought some Canadian savings bonds. I was 12 at the time. Then it was in a high school class where we had a project to look at the the stock section in the business news and to pick a stock and to follow that stock for the 5-month period in class. And I picked a company called Fort Zanny Group. Fort Zanny Group, I believe they ran the Athletes World in the malls, and they were bought out by Canadian Tire. I didn't put much research into Fort Zanny Group, and I think it just traded flat.
Right.
But that got me really excited about the stock market and the fact that you can invest in these companies and you actually can make money alongside other investors.
Now, that reminds me of what you said in your blog, that compound interest is magic. What do you mean by that?
It's definitely magic. Let's say you put $100 into a stock like Fort Zanny, and the average compound annual return of the TSX over about 50 years is 10%. So you put $100 in the market, 10% the first year, and so you get $10 out of that. So then you have $110 at the end of the year. You compound that again in year 2, so $110 compound at 10% is then $121. It's kind of like a snowball. So the snowball will go down the hill faster and faster the bigger it gets, and that's the beauty of compounding your money.
Right, and you know, any investor, whether you're a millennial or not, will say that sounds great. But what are the risks associated with getting into investing in a company and wanting that compound interest to work in favor for you?
Yeah, so there's always a risk of investing in stocks, as there is even with investing in bonds and even buying gold and other commodities. With investing in stocks, it's important to understand the companies in which you're buying. So the companies I like to buy are ones in which are operating everywhere, like where I go on a daily basis, like Dollarama, for example. I see CGI Group everywhere, Spin Master Toys. I bought all the little kids in my family, some little toys they created. And it's understanding what you know, it's diversifying your portfolio so you're not just concentrated in a couple of stocks. And not risking all of your capital are really the 3 things I'd recommend.
Okay.
Yeah.
Now, do you think that, especially when you value invested in 2008 and now, how afraid were you and how did you get over emotional investing that a lot of investors are challenged by?
So I've always been a growth investor, so I look for those companies that can compound at a greater rate than other companies. So that's through, you can see at their return on capital and the return on equity rates. It's really the managers of each of these companies, like for example, Dollarama, Larry Rossi, his ability to allocate free cash flow to the highest rates of return in the business. And that translates to share price performance. So I like to buy those growth companies. But when I do turn into a value investor, quote unquote, is again, like you said, during a recession, or like the bear market we just went through. So in 2014, coming into 2015, the TSX entered bear market territory. So into 2015, it had dropped from its high in 2014 about 25%. So I know through data that the average bear market in Canada in the TSX will drop only about around 28%. So we were close. We were down 25%. I thought that was a good time to deploy some of my cash that I had sitting on the sidelines into some of these great companies I already had in my portfolio. And so I did just that based on the data. So at the end of 2015, beginning of 2016, I started adding capital into the stocks in my portfolio, and sure enough, like we've come back from those lows. So the important things during a financial crisis like 2008, during a bear market like we saw after the oil crash 2014-15, start deploying some capital when there's a lot of fear in the market. When you see headlines like "Sell Canada," that's usually when I start buying into Canada and buying into stocks again.
Right. Yeah. Now that's interesting because marijuana stocks right now are hot, but there's also the fear that it's too risky. What is your thought on that?
So if you do pick up my book, Market Masters, which is available in stores everywhere, you'll see in the conclusion, the 50-page conclusion, I actually started buying Tweed, which is now Canopy Growth Fund, about 2.5 years ago.
Yeah.
And it was around $1 per share. And it wasn't generating a profit. It wasn't one of the typical companies I would add to my portfolio, but I understood that marijuana is a growth industry. There's a big addressable market, as you know. And I compare the growth to the licensed marijuana producers to what happened to Blockbuster. So, for example, Netflix just totally ate Blockbuster's lunch.
Yeah.
Now, it's an interesting comparison, but with these licensed marijuana producers, they're pretty much going to put those dealers out of business. So it's a wonderful shift, and you can really profit off that shift by investing in these companies that are available on the stock market. I bought into Tweed, it was named at the time at around $1 per share. It's become a 10-bagger, so it's generated 10 times the investment for me. Now, whether I think it's in bubble territory, I can't say, but I had a huge margin of safety then, and I was operating, my decision process to buy Tweed was on a multitude of factors, which I call optionality. If any one of these options or factors were to play out, I think Tweed would have moved up.
Right.
For example, Trudeau getting voted in through the Liberal Party, that hadn't happened yet. That was one of the things that could play out. Legalization of marijuana, which we know will happen in 2018, Tweed becoming the market leader, which I predicted they would in North America, and again, a whole multitude of factors where I thought there's a lot of optionality in this small cap, and I think things are going to work out. And sure enough, Canopy Growth Fund has become the leader in the market.
A complete leader.
Yeah.
Well, okay.
Yeah.
And interesting. What is your portfolio breakdown?
Okay, so my portfolio breakdown, over the years, I've kind of cemented a three-part breakdown. So the first would be those large caps, not just any large cap. Those are large caps that are mispriced. So for example, Starbucks in 2007, 2008, at the beginning of the credit crisis, the stock dropped close to 50%. It was not only the credit crisis, people tightened their belts, maybe not paying for those lattes every day, but then new entrants like McDonald's, Dunkin' Donuts, really shoring up their coffee offerings. I bought into Starbucks. It was a mispriced large cap when it dropped 50%. It's done very well for me now. It's a 10 or 11 bagger. So the first part is mispriced large caps. The second part would be in the mid-cap space. Those would be the capital compounders I talk about. So they haven't become large cap companies yet, but they're compounding at an amazing compound annual return around, let's say, 15 to 25% on an annual basis. And they're run by amazing managers that can allocate capital just amazingly. The third bucket would be those small caps like Tweed we talked about. Those are companies that haven't proven themselves yet, but they have a lot of optionality. They might not be generating a profit, but I would take a bet on something like Tweed, for example. Yeah.
All right. Well, lastly, let's share where we can learn more from you and maybe even talk to us about your YouTube channel. Okay,
sure. So definitely pick up my book, Market Masters. You can learn more about me on RobinSpeziale.com. You can go onto my YouTube channel, like we just talked about. There I have, for example, the speech I gave at the Fairfax Shareholders Dinner. Type my name into Google and you'll find tons of things.
Okay, thank you, Robin, for your time.
Thank you for having me.
For more millennial content, you can go to SmallCapPower.com.